Welcome to our review of the first quarter and our market outlook for the rest of 2024. Let's get into it. So before we get into the specifics, as always, this video is not intended as financial advice, informational purposes only. So Q1 was really a highlight reel for stocks. The S&P 500 closed out the quarter at a new record high. Index jumped about 10% in the first quarter this year, even as the bond yields rose on markets essentially pricing out rate cuts. The U.S. 10-year Treasury yield was pretty much flat, finished right around where it started at about 4.2%. But as you can see here on this chart, U.S. growth continued its streak from 2023, outperforming relative to essentially all the other asset classes. Now, overall, U.S. equities as a whole led the way compared to, international, emerging, and fixed income markets, especially, as you can see on the screen here. So the question is, what has been the big driver of these U.S. equity returns? Well, really, the U.S. stock market remains concentrated in top names, and so does its performance, which we expect that momentum to continue. Essentially the top 7 names in the S&P 500 accounted for about 60% of the returns of the index as a whole. And, fun fact, Apple and Tesla, they're no longer in the top 7 list, and they've actually been 2 of the biggest detractors from the S&P 500 performance year to date. So essentially we're going to watch for markets to start to broaden out, but currently we prefer an overweight to large cap quality growth and tech names. And you might wonder, why is this? Well, really, sales, earnings, and forward guidance from some of the largest names in tech have crushed even the loftiest, of expectations. While, the price moves in these stocks have been big, right? They went up a bunch this year. They've actually arguably even gotten cheaper as their ability to generate cash flow has outpaced the corresponding price appreciation. So taking this into account, it really adds fuel to the bullishness and has persuaded us to tilt even more aggressively into growth over value and into those names specifically that are driving earnings. So the question is, what's our outlook and how do we currently have strategies deployed? With equities, our main theme revolves around, again, that overweight to U.S. quality. And what I mean by that is just companies with strong balance sheets relative to other asset classes, as essentially the expectation that we think the winners are going to keep on winning. Also seeing a trend where the momentum behind these equities, we expect that to continue to build, making them that quality portion choice for the portfolios. On top of that, growth expectations are getting revised for the economy as a whole as the Federal Open Market Committee, or the FOMC for short. They essentially came out and they bumped their real GDP growth expectations, which essentially signals a strong economic backdrop for these stocks to participate in. Financial conditions are also loosening. We got greater availability and lower cost of credit. Essentially, that enables many companies to beat their earnings expectations over the last quarter, which we expect to continue. And this all reinforces our decision to stay overweight in equities, particularly those large, high-quality names that have been driving markets higher. Now, on the fixed income front, we've definitely done some repositioning. With the economy rolling and still this sticky, persistent inflation, along with guidance from Jerome Powell, he's the head of the Federal Reserve, it suggests that we might not get rate cuts until later this summer, if at all. Markets are now pricing in 3 cuts for the year, down from 6 that they expected back in December. So as we anticipate these cuts later this year, we're definitely positioning ourselves to take advantage of what I would call, the belly of the curve, of the yield curve. This area offers the greatest potential for total returns, especially considering all the unique dynamics going on in the markets. And with the positive economic outlook on the horizon, we're also going to start to eye opportunities to secure and lock in those high yields through carefully selected bonds. It's really about being in the right place at the right time, and I think that this approach puts us in a great position. So a little bit of market history for you. So the Fed has cut rates before. Back in 1995, the Federal Reserve did its maintenance cuts 3 times. Essentially, they cut rates 75 basis points, quarter point each time. And this year, essentially expect the Fed to cut rates in similar fashion. So based on this, what can we expect? Well, to summarize, bonds outperform cash across the curve when the Fed cut rates into that soft landing that year. The reason being, essentially as rates come down, you also get price appreciation in bonds. Essentially because you're now holding paper, paying a higher coupon than you can go out and get, say, at the prevailing market rates. So that paper is now worth more. So for example, if you have a bond you bought before the cuts paying, let's say 4%, and now markets rates are at 3%, which one do you think someone's willing to pay more for? Obviously the one paying 4%. So as we're drawing now from a similar deck as we did back in 1995, this really supports our case for bonds over cash today, because you aren't only going to get that higher yield that you're locked in, but you're also going to get that appreciation potential, just given that inverse relationship between interest rates and bond prices. So there you have it. Quick little review of the first quarter and outlook going forward here. If you are a client, you've already received your personalized performance recap and net worth progress reports from the last quarter. As always, please don't hesitate to reach out if you have any questions. Stay the course, stay on point. Everybody take care.